In this section, we'll be discussing cryptocurrency market cycles, a crucial concept for investors to grasp. Market cycles refer to the repetitive patterns that financial markets, including cryptocurrencies, experience. By understanding these cycles, investors can make informed decisions and potentially maximize their gains while minimizing risks. In the following sections, we'll dive deeper into the different phases of market cycles, the indicators and tools used to analyze them, and strategies for navigating these cycles. Stay tuned to learn more about how to successfully invest in the ever-evolving world of cryptocurrencies. In this part, we'll explore the 4 primary phases of cryptocurrency market cycles: accumulation, expansion, distribution, and contraction. During the accumulation phase, savvy investors accumulate assets when prices are low, often flying under the radar of the broader market. Next comes the expansion phase, when the market gains momentum, and prices start to rise, attracting more investors. This phase typically garners increased media attention, pushing even more people to join the market. The distribution phase follows, characterized by the selling of assets by early investors who aim to cash in on their profits. This stage often coincides with heightened media hype and widespread FOMO, fear of missing out. Finally, we have the contraction phase, where the market corrects itself, and prices fall due to reduced demand and increased selling pressure. This phase can be marked by panic selling, leading to a further decline in prices. Understanding these phases and identifying where we are in the cycle is vital for successful cryptocurrency investing. In this section, we'll discuss how market sentiment plays a crucial role in the cryptocurrency market cycles. Market sentiment refers to the overall attitude of investors towards a specific asset or market. Positive sentiment can fuel price increases, while negative sentiment can lead to price declines. It's essential to keep track of market sentiment as it can provide insights into potential shifts in the market cycle. Market sentiment can be influenced by various factors such as news, social media, and general market trends. For instance, positive news about a cryptocurrency can lead to increased buying pressure and a shift towards the expansion phase. Conversely, negative news can lead to selling pressure and push the market towards contraction. In the cryptocurrency market, sentiment can change rapidly, and investors must stay informed and be aware of the potential impact of these changes on their investments. By understanding the role of market sentiment in cryptocurrency market cycles, investors can make better informed decisions and potentially mitigate risks associated with rapid market shifts. Stay tuned for more in-depth discussions on cryptocurrency market cycles and strategies for navigating them. In this section, we'll explore the importance of risk management in cryptocurrency market cycles. As we know, the cryptocurrency market can be highly volatile and subject to rapid price fluctuations. To navigate these market cycles successfully, it's crucial to have a solid risk management strategy in place. Risk management in the context of cryptocurrency investing involves identifying, assessing, and taking appropriate measures to minimize potential losses. There are several ways to manage risk in the cryptocurrency market. One popular approach is diversification, which involves spreading investments across various assets to reduce the impact of any single asset's poor performance. Diversification can help mitigate risk by ensuring that a portfolio's performance isn't solely reliant on one asset. Another risk management technique is position sizing, which involves allocating a specific percentage of a portfolio to a particular investment. By limiting the size of each investment, investors can reduce the potential impact of a single poor-performing asset on their overall portfolio. It's also essential to have a clear exit strategy in place, including setting stop-loss orders to limit potential losses if the market moves against an investor's position. In summary, risk management is a crucial aspect of navigating cryptocurrency market cycles successfully. By employing strategies such as diversification, position sizing, and having clear exit plans, investors can better manage the inherent risks of the volatile cryptocurrency market. Stay tuned for more insights on cryptocurrency market cycles and how to thrive in this dynamic environment. In this section, we'll discuss the role of sentiment and psychology in cryptocurrency market cycles. The market is heavily influenced by the emotions and beliefs of its participants, and understanding this can help investors make more informed decisions. One of the most well-known market psychology concepts is the fear of missing out, or FOMO. When prices are rising, and the market is in a bullish phase, investors may feel compelled to buy assets to avoid missing out on potential gains. This can lead to a positive feedback loop, with increasing prices driving even more buying. However, this can also result in unsustainable price growth, eventually leading to a market correction or even a crash. Conversely, when the market is in a bearish phase, and prices are falling, the prevailing sentiment may be one of fear and panic. In this scenario, investors may be more likely to sell their assets in an attempt to minimize losses, which can exacerbate the downward trend. This is where the concept of capitulation comes in, referring to the point where investors give up on their assets, selling at a loss and contributing to the market bottom. Understanding these psychological factors can help investors avoid making emotionally driven decisions that can lead to losses. Instead, focusing on the fundamentals of the assets they're investing in and maintaining a long-term perspective can help investors stay on track during the ups and downs of market cycles. In conclusion, sentiment and psychology play a significant role in cryptocurrency market cycles. By recognizing the emotions driving market trends and maintaining a rational, long-term perspective, investors can make better informed decisions and navigate the market's cyclical nature more effectively. Stay tuned for more insights on the fascinating world of cryptocurrency market cycles. In this section, we're going to explore strategies for navigating cryptocurrency market cycles. Understanding market cycles and how they work can be the key to making better investment decisions and managing risk in the volatile world of cryptocurrencies. First, it's essential to have a solid understanding of the fundamentals behind the assets you're investing in. This includes knowing the technology, the team, and the use cases of the project. By investing in projects with strong fundamentals, you increase the likelihood of long-term success, even if the market experiences short-term volatility. Next, consider dollar cost averaging, DCA, as a strategy to manage risk. By investing a fixed amount at regular intervals, regardless of market conditions, you can reduce the impact of market volatility on your investments. This approach also helps avoid trying to time the market, which can be challenging and often leads to poor investment decisions. Another important aspect of navigating market cycles is maintaining a long-term perspective. While it can be tempting to try and make quick gains during bull runs, keeping a long-term investment horizon allows you to ride out the market's ups and downs, which can lead to more significant returns in the long run. Finally, don't forget the importance of diversification. Investing in a range of different cryptocurrencies, as well as traditional assets like stocks and bonds, can help to mitigate risk and reduce the impact of any single asset's performance on your overall portfolio. In this section, we'll discuss the role of sentiment analysis in cryptocurrency market cycles. Market sentiment plays a crucial role in determining cryptocurrency prices, and understanding its impact can give you an edge when making investment decisions. First, let's understand the impact of market sentiment on cryptocurrency prices. In the world of cryptocurrencies, market sentiment can have a significant influence on price fluctuations. Positive sentiment often leads to an increase in demand, pushing prices higher, while negative sentiment can cause a decrease in demand, leading to falling prices. It's essential to be aware of the prevailing sentiment in the market to gauge potential price movements and make more informed investment decisions. Next, let's explore some tools and resources for monitoring and analyzing sentiment. Various platforms and tools are available to help investors keep track of market sentiment. These include social media platforms like Twitter and Reddit, where you can follow influential individuals in the crypto space and gauge the general mood of the community. Additionally, there are dedicated websites and tools like Santiment and Lunar Crush that provide sentiment analysis data for cryptocurrencies, allowing you to get a more detailed and quantitative understanding of market sentiment. Lastly, let's discuss strategies for incorporating sentiment analysis into your investment decisions. Sentiment analysis can be a valuable component of your overall investment strategy, but it's essential not to rely solely on it. Instead, use sentiment analysis in conjunction with other fundamental and technical analysis techniques to get a more comprehensive view of the market. Furthermore, always be aware that market sentiment can change rapidly, so it's crucial to stay updated and be prepared to adjust your strategy accordingly. By understanding the impact of market sentiment on cryptocurrency prices, using the right tools and resources to monitor and analyze sentiment, and incorporating sentiment analysis into your investment decisions, you can better navigate the ever-changing cryptocurrency market cycles. In summary, understanding and navigating cryptocurrency market cycles can be an essential aspect of successful investing in this space. By focusing on fundamentals, employing strategies like dollar-cost averaging, maintaining a long-term perspective, and diversifying your portfolio, you can better manage risk and capitalize on the opportunities that market cycles offer. Stay tuned for more insights on the world of cryptocurrencies and investing. In this section, we'll be discussing the prevalence of scams in the cryptocurrency space and the importance of staying informed and vigilant. The world of cryptocurrency is an exciting and innovative one, but it's not without its risks. Scams have become increasingly common as more people are drawn to the potential profits in this industry. By being aware of the various scams out there and exercising caution, you can protect your investments and avoid falling victim to these schemes. Remember, staying informed and vigilant is key to navigating the crypto space safely.